Hello, ladies and gentlemen. My name is Greg McCloskey from ForexLive.com. Today's day is March 31st, end of month, end of quarter, end of Japanese year end, and the day before the U.S. employment report, which is going to focus on right now and how to trade it. First off, on our website at ForexLive.com, I've put some infographics, okay? I title it Infograph, a look at the U.S. employment trends. And if you scroll down, you can see those infographics. Just goes through what the trends have been in the unemployment reports of late, and also outlines the estimates for tomorrow's numbers. So be aware and understand what those trends are, just for your own guide, and also in particular what the estimates are. Now, tomorrow at 8:30, the report is going to be released. And what do we know about it? Well, we know certain things, that the non-farm payroll is going to come in around 206. So that's the estimate. Now, there's going to be either that's going to be low or high, or it's going to be as expected. If it's low or high, you'd expect the market to move either to the upside or the downside. And I want to use the euro as a proxy for how I would trade that report. Now, before I get into technical levels and how to trade it, I want to make one thing clear. Tomorrow at 8:30, the risk is going to be at sky-high levels. Why? Because there's three components of risk. One is market risk, and that's the risk that you and I face every second that the market is open, okay? If there's an auction going on between buyers and sellers, we have market risk that the buyers are going to be stronger than the sellers at that time. That is the first type of risk that we have, and we can hedge that because traders tend to pay attention to technical levels. Like they might pay attention to this trend line, or they might pay attention to this 200-hour moving or 200-day moving average here and the 38.2% retracement, and buy the market against that. They might pay attention to the trend line right here. And so market risk can be, you can use technical levels to define your risk and limit your risk, and that protects you as a trader. That's the type of market that I prefer to trade in. Now, there are two other types of risk, and one is event risk and liquidity risk. Event risk includes things like the unemployment report, which will be released tomorrow. It includes things like the Belgian, unfortunately, like geopolitical things or terrorist activities that may cause the market to go one way or the other. It includes things like Chairman Yellen's speech from 2 days ago that caused the dollar to move sharply to the downside. All these things are event risks that we as traders don't really know. Some of it is as expected, some of it is not expected, but we know that this event is going to happen. It's going to move the market one way or the other. Either the non-farm payroll is going to come out at 206, or it's going to come out at 156, or it's going to come out at 256. And whether it comes out at 256 or 156 is going to cause the market to move around, depending upon how the market interprets that, and all the supply and demand conditions and all the things that go in the pot that cause the price to move one way or the other. But the point is, as the event risk happens, risk for event risk is going to be sky high, and then it's going to be known, and then we can get back to the market, trading the market risk, where we use our technical tools. The third type of risk is liquidity risk. Liquidity risk is increased when event risk is high. What is liquidity risk? Liquidity risk is that your broker's bid-offer spreads go wider, that the market moves around in very choppy and volatile actions, maybe gapping by 10, 15, 20, 30 pips one way or the other, maybe even more at one time. That is liquidity risk. And so at 8:30 tomorrow, folks, guess what event risk and liquidity risk and market risk will be at? Sky-high levels. If you had a scale, it would be red, not orange, not yellow, not green. It would be red, sky-high. Do I want to trade during sky-high risk levels as a retail trader? No. I don't. It's like do I want to get in a barroom fight? No. Anything can happen in a barroom fight. Anything can happen tomorrow at 8:32. We don't know what's going to happen. And so when do we want to trade? After the fact. 10 minutes, 15 minutes, let the market, let the liquidity risk and the event risk work its way out. Have yourself understand what the data means. Make sure that the revisions aren't a surprise, or that hourly earnings or some of the other things are what you expected and come out. If it's mixed, if the data is mixed, you might as well shut the screen off and enjoy your weekend. If the data is a surprise bullish one way, unequivocally bullish or unequivocally bearish, maybe you want to get involved. Maybe the market has a potential to trend. Now you get to your trading and what you need to do as a trader. And one of the things that I like to do, or one of the things that I do, is I take a look at what level, if it broke either to the upside or the downside, would turn the bias unequivocally more bullish or unequivocally more bearish. And if we look at the euro versus US dollar, if I were to pick a level that is more bearish, okay, bearish from where we are right now, I would take a look at this trend line right here. And I look at this trend line right here, and if the market should break this line right at this level, through that level, I would expect that this would be looked at as a failure up here, a failed break to the upside, and we would be talking about how the market failed up here and moved further to the downside on the first day of April. Down the road we won't know it's unemployment day or whatever, but tomorrow we'll know that that would be the case. And so I would expect. And it doesn't necessarily mean it's going to happen, that if the price were moved below that trend line, that would be more bearish for the euro versus US dollar. So I want to know where that level is, and I'm going to monitor if the price goes below that level from some surprise tomorrow that would cause the dollar to get lots stronger and the euro to get weaker, that if we move below that level, which comes in around the 113.22 or something tomorrow, 22 level tomorrow, currently about 60 pips away, 65 pips away from the current market level, that would be more bearish, okay? And for those reasons, we're going below that trend line, which is a key trend line. Now, what level would be most important on the top side for me? And in this case, I would say this getting above this yellow area right here. If we go back to February of 2015, we had some highs here in this yellow area, highs here and highs here. We broke above that level here. We'll ignore that right now. And then we had a high here. And then we had one day where the market moved above it. The next day we moved back down. So let's call this sellers against this high right here. If we just discount this this area right through here, where the market moved above that yellow area and moved higher and then came back down 2 days later, this has been a ceiling for the euro versus US dollar. So guess what? If a ceiling is broken, what should the price do? It should go higher. And so this would be the level that I would expect that if we move above and we stayed above, that would be more bullish for the euro versus US dollar. What would cause that? Some weaker number, hourly earnings coming in at 0.0 or minus 0.1, something along those lines that would cause the market, the euro versus US dollar, to continue its move to the upside, continue its bearish bias that way. So in a nutshell, that's trading the unemployment, folks. It doesn't have to be complicated. All you have to do is set your parameters. Understand that risk is sky high tomorrow at 8:30. Don't go getting yourself in a barroom fight. It's not worth it. You're probably going to get yourself beat up one way or the other. And if the number doesn't come out with any huge big surprise, just turn the screen off or trade very little and enjoy your weekend. All right. My name is Greg Michalowski for ForexLive.com. Before I go, if you like this video, make sure you go to the YouTube channel and click the thumbs up. Also, if you want to subscribe to our videos, you can go to our YouTube channel and click the subscribe button. Good fortune with your trading. Bye-bye, everybody.